I'm very pleased to welcome back to the show now Peter Grandage. You can find him at petergrandage.com. Peter, first of all, I appreciate you finding time for us on the weekend.
Well, Mike, I don't make time much more for media appearances, but when I heard from Grant that there was an availability to be on your show, I absolutely cleared my schedule. It's just a true honor to be back speaking with you again.
Well, it's great to have you, especially at this time. I mean, there's so much happening. I mean, I know you have been one who've been very, very positive and supporting of Canada-U.S. relations, but it looks like they're at a low point. You know, we could pick a year in the last 20 or 30 or 40 years, I don't know what, but they're at a low point right now. You know, I'm really interested to get your take on the overall environment that the markets are operating in.
You're right. You know, several years ago, I used to publish a newsletter called North of the Border, which was geared for Americans to look at Canada as an investment. And the majority of people who read that letter were people from Canada who wanted to see what an American was saying about investing in Canada. And, I always had a love, as I wrote earlier this week when I knew I'd be on your show, to my readers here, that, Canada was a home away from home for me. From Vancouver to St. John's and everywhere in between. I've always joked, and many who've seen it, I said one of the best movies that ever described our relationship was the Candy movie, Canadian Bacon. And it really poked fun at both sides, but it really showed how America had many similarities. And a lot of that in recent weeks and months has, been ripped apart. And it's shameful because there's really been no better two allies, and there's certainly no two groups of people who really, in a sense, I don't want to say needed each other, but by working with each other have benefited from it. And so my hope is that whatever may have been disrupted isn't long-lasting, and we can return at least to something of what it used to be to me, which was just, the two greatest groups of people that got together.
Let me come to the markets here for a minute, and again, you take me where you want, but let's start with an overview on the market. I know you've issued to your people at petergrandage.com saying you weren't comfortable with the market. You're probably pretty happy with that call, by the way, in the last little bit. But where do you stand now?
Sure, Mike. It's unique that we talk at this time. We began last week I began personally with the biggest short position I ever had against the U.S. market, and then I ended the week with the biggest long position I ever had to gold and major mining stocks, something I have not invested in few years, almost for the 5 years I've been away from working in the metals and mining industry. So it comes at a unique time that that I find my own personal investments, and what's good for me is not necessarily good for someone else that's listening, but I am heavily short the U.S. equity market, and I'm just as we ended Friday, the longest dollar-weighted position I've ever had exposure to gold and major mining companies, not juniors, but majors.
I'll come back to gold in a second. I'll stay with the broader market at this point. What's making you nervous? Is it simply you're watching price action there, we maybe got ahead of ourselves in the stock market? What's got you nervous at this point?
Mike, I couldn't conceivably speak and address most of it in the time that we have. I'll just try to take a few of the key points. Perhaps the most is the simplest of valuations. I've been around this thing. You and I have been around a long time, and when you vis-a-vis and compare it to other times and other opportunities, it's very hard to justify that stocks are not very, very expensive. The other concern I have, and this is as important, is I've never seen complacency both by the public and the so-called professionals at such an extreme. It's almost as if no one believes there's any way that this can go down. And the way you can see that and identify that is that while the Dow Jones Industrial Average is basically flat for the year, the NASDAQ is up, and within the NASDAQ, what we know as the FANG stocks are up, and within that, the most heavily shorted stocks in the States right now have had the biggest gains. And that's almost always what happens right at the end of a bull run. So even though with high-frequency trading and computers have dramatically changed the game that you and I first entered when the public at large was the main factors influencing markets, those things still matter. And it's just that and the simple fact that in all comparisons, and not even getting into geopolitical arguments and economic and social arguments, I believe America has already entered its worst ever period for social and political environment, and is on a threshold of entering its economic as well. I've never seen such a divided country. I find no middle ground. Not only is the middle class being destroyed in America, but middle opinions are being destroyed. You're either pretty hard left or pretty hard right. So I just really think the stock market is extremely vulnerable, at least to a major correction, and I really feel that we're at the peak of a major cycle, and that's why, for my own self, I've taken such a short position in the market.
Let me talk about also you're against one of the things that, of course, has been characteristic of the bull market has been these record low interest rates. But clearly, we had another rate rise, in June from the Federal Reserve. They say there's more to come. So that, you tell me, but that seems to me like a major environmental, change in the financial environment when you've got competition now starting to come in, and instead of the stock market, hey, I can get a better return in fixed income or at least in the short term interest rates.
I think what has not been really spoken about, because down here at least, Mike, I can't speak to the Canadian media, I can only speak to the U.S., it's mostly a don't worry, be happy kind of mentality on our financial network. So there's very little bearish views, or if they're around, they're usually made fun at. But one of the things that isn't being spoken about here is the dramatic change in monetary policy. I don't think people have yet grasped the major switch that's evolving here. It's clear the United States is no longer has its foot on the pedal and just creating money out of thin air like there's no tomorrow. The latest Fed meeting, the chairman was clear and evident that that's what's the case. Draghi didn't actually take his foot and put it on the brakes. He's eased up off the pedal. The same thing is happening in Japan, and now it's evident it clearly happened in China. And what people don't understand, it's really been this unbelievable insanity of trillions upon trillions of dollars created out of thin air and fed into a punch bowl that everybody was drinking up. And while there's still something left in the punch bowl that's already been put there, there's not going to be refills. And people are acting as if refills are just going to be continuously happening. And that ties into, yes, interest rates rising, but it's not so much interest rates rising. It's the simple fact of that quantitative easing is basically, at least for this point in time, been put to bed. And that the effects and what's going to transpire without it combined with a mentality of people that just think, you buy the dip and it always comes back, is really setting us up for some very vulnerable to sharp corrections, if not a major new bear market.
I'm talking with Peter Grandage. You can find him at petergrandich.com, petergrandich.com. And I'll tell you, I'd suggest you go there, because one of the things you can do is you can click on there under resources. Peter's also the author of the book Confessions of a Former Wall Street Whiz Kid. Had great reviews. It's in the 3rd edition, and I got personally a lot of value from reading that book, hearing someone who's been around that long say, this is what I've learned about this business. And it's also an enjoyable read. But I just, Peter won't mention it, so I wanted to, petergrandich.com. But just go to resources, and you can look under there his book. It says Peter's book. Just click on it, because I think you're going to find you'll just enjoy the read, but you'll also get further ahead by understanding it. And just another reminder that you can help me out by going to the goldcorpinvitational.com, because it is live right now to go ahead and bid on all sorts of auction items to raise money for Special Olympics. And I promise you'll be bidding against me, Victor, Mike, and Ozzy, but lots of great stuff there. Hey, I'm really enjoying my conversation with Peter Grandage. You can find him at petergrandage.com. Hey, Peter, before the break, you said to us, for the first time in a while, you're back into the gold market. You're looking at some seniors there. Tell me why.
Well, like I said, Mike, it's been almost 5 years. I don't work in the metals and mining, so I don't have any biases there. I don't represent any gun manufacturers, dry food manufacturers, or people selling log cabins in the woods. It's strictly just from an investment standpoint. I have no biases. I have nobody to make happy if I say something nice about gold other than my hopefully bottom line performance. And when I look at the gold market, especially at all the other vehicles that are made available to me right now, it's really one of only a handful that I can find where there is an overvaluation. In fact, if you're willing to look at the mining companies, and I'm not talking exploration, I'm talking about significant producers, emerging producers, and higher, compared to the 35 years I've been in the business, compared to where the market is, and how close the supply and demand scenario is for the underlying metal itself, they're just too compelling to pass up. It's certainly, I think they have far less risk of losing money from here, and I think that's a thing we missed in our years, especially in our early years. It wasn't how much we made, it was how much we didn't lose that would really separate us, from the pack. And I just think there's very little risk in the gold market and these producers. I think there's going to be a very big, significant M&A start taking place here in that area. I just think, it's basically now the majors have no other choice but to do that. And just so many positive other reasons happening economically, geopolitically, and politically, and it's just worthy, from my opinion, versus trying to find stocks or bonds, or even in many cases real estate now, where basically most things are fully priced, if not overpriced.
And what kind of, you've already alluded to this, but this just maybe reemphasize, when you look at something like that, what's your hold period? What do you expect, or what should be a minimum? Because I always think people think way too short term.
Oh, yeah, Mike, that's the other thing. When we entered the business, research reports had a 3 to 5 year outlook. Now it looks like it's 3 to 5 minutes. No one seems to work a year with a plural anymore. I really think if people can look past the next few months, say to myself, okay, over the next several years, if someone took my child and I had to get him back, do I want to bet on it being a FANG stock, a bond, or gold? I would gold. Gold has $100, $150 risk to the downside, and it has a $500 to $1,000 upside, and it takes 5 years to do that. I can hopefully still be around to enjoy that. And I just think, like I said, I think there's far less risk of losing money in it than now if I first start establishing positions in equities and bonds.
Peter, as always, it's such a pleasure to get a chance to chat with you again. Great advice, and I'd invite people to go to petergrandage.com. You can get to the blog and get his latest updates, but I'm telling you, go to the resource side and look at Confessions of a Former Wall Street Whiz Kid. That Whiz Kid is Peter Grandich. Peter, thanks for finding time. Appreciate it.
Mike, for the honor of speaking to you again.